Hey everyone, welcome back to Corporate Decoder, the place where we dig into the nitty-gritty of corporate filings so you don't have to, and this time we're looking at Auburn National Bancorporation's 10K. Don't let the name fool you, even though it sounds like it's about vintage cars, this report is all about the bank's financial health and what they see coming down the road. We're diving deep into everything from risk factors to management's analysis, so buckle up. The big story here is how this small community bank is navigating some pretty turbulent economic waters and how that might affect your money if you're banking with them or thinking about investing. First off, let's establish what this document even is. It's a 10K form, basically Auburn National Bancorporation's yearly report card filed with the Securities and Exchange Commission, or SEC. Think of it as a super detailed annual report where they lay out all their financial info and what they think will impact the company. This report covers the year ending December 31, 2024, so everything we're about to discuss happened or is expected to happen around that time. Auburn National Bancorporation is the parent company of Auburn Bank, a real community bank operating since 1907, focused on East Alabama that includes Lee County and the surrounding areas. An important factoid from page 6 is that this bank had the largest share of the Lee County deposits at June 30, 2024, 21.3%. Now, before we get too far, there's a whole section dedicated to what they call forward-looking statements. Basically, it's a disclaimer saying, hey, we're making predictions about the future, but a lot of things could change, so don't hold us to it. This is where they talk about everything that could throw a wrench in their plans. Economic downturns, changes in regulations, even wars or natural disasters. They talk a lot about economic conditions. Factors such as inflation, seasonality, natural disasters, climate change, war, terrorism, trade restrictions, governmental monetary and fiscal policies, legislative, executive branch and regulatory changes, banking, securities, and tax laws. One particularly interesting bit here is their concern about regulatory changes. Banks operate in a world of rules, and changes in those rules can have a big impact on their business. They worry about changes caused by executive orders, potential reorganization of bank regulatory agencies, changes in leadership at the bank regulators, and the uncertain effects of all these changes, including the costs and benefits. Speaking of concerns, the report gets into a detailed breakdown of risk factors. These are the things that could really hurt the company's performance. Let's talk about some of the big ones. They highlight risks tied to changes in borrower liquidity, credit risks, savings, deposit and payment behaviors, and the risk of market interest rates and the accuracy of estimates, all of which factor into the allowances for loan losses and asset impairments and potentially affect the company significantly. Of course, cybersecurity is top of mind for everyone these days. They acknowledge that cyber attacks and data breaches that may compromise their systems or their vendors' systems or customers' information. Here's something that might interest investors. The report mentions that their dividends, share repurchases, and bonuses are limited by regulations tied to maintaining a capital conservation buffer. That means there's a cap on how much they can pay out, which could affect shareholder returns. Page 6 mentions that the banking business in East Alabama, including Lee County, is highly competitive with respect to loans, deposits, and other financial services, and that Lee County is served by 19 banks, 10 of which are headquartered outside of Alabama. This competition is a large risk factor for the company. Jumping ahead to page 1, the aggregate market value of the voting and non-voting common equity held by non-affiliates is around $41 million as of June 30, 2024. Keep in mind the number of outstanding shares of common stock, which numbered around 3.5 million as of March 10, 2025. The company is also proud of its human capital, stating that at December 31, 2024, the company and its subsidiaries had 145 full-time equivalent employees, including 39 officers, and that our employees have been with us an average of approximately 11 years. The company has also established an equity and incentive compensation plan that they believe will provide the flexibility to attract and retain talented people in a competitive market. Okay, so what about the rules that Auburn National has to play by? As a bank holding company, they're heavily regulated by the Federal Reserve, the Alabama Superintendent of Banks, and the FDIC. There are some important rules that govern them, like having to get approval before acquiring more than 5% of another bank and being limited in what kind of businesses they can get into, mostly banking-related stuff. The Alabama Superintendent and the Federal Reserve keep a close eye on the bank's activities, covering everything from loans to capital levels, payment of dividends, establishment off branches, and compliance with laws. The FDIC also regulates the bank, along with various other regulations applicable to FDIC-insured banks. The Federal Reserve also has its own CAMELS rating system that focus on the risk profiles and management's ability to manage the bank's liquidity. New Community Reinvestment Act regulations, which become effective January 1, 2026, are coming down the line. These regulations continue to confirm that CRA and fair lending responsibilities and compliance are mutually reinforcing, and the importance of ensuring that the credit markets are inclusive. The regulations would require banks to be classified as small, intermediate, large, or limited purpose banks. The federal bank regulators have also updated their guidance on overdrafts. This has been a CFPB concern, which began refocusing on this issue in 2021 with a view to ensure that banks continue to evolve their businesses to reduce reliance on overdraft and not sufficient funds fees. Of course, there are sanctions that financial institutions like Auburn Bank have to comply with regarding Russia, Iran, North Korea, and Venezuela. FinCEN has issued several alerts since the Russian invasion of Ukraine began, and financial institutions may be targeted by cyber attacks stemming from Russia and other countries. The Federal Reserve also has set risk-based capital guidelines, as well as minimum leverage ratio guidelines. The amount of dividends and discretionary bonuses is limited by capital conservation buffer of 2.5% and eligible retained income over rolling 4 calendar quarter periods, according to the Federal Reserve. Their commercial real estate loans are also regulated and scrutinized, and is defined as exposures secured by raw land, land development and construction, including 1 to 4 family residential construction, multifamily property, and non-farm non-residential property. The CRE guidance requires that banks have appropriate processes be in place to identify, monitor, and control risks associated with real estate lending concentrations. Let's look at some key financial data from the report. The company's net earnings were $6.4 million for the full year 2024, compared to $1.4 million for the full year 2023, an increase of 358%. Net interest income was also up to $27.1 million compared to $26.3 million the prior year, a 3% increase. They attribute the improved net interest margin to loan growth and the balance sheet repositioning last year that shifted their asset mix. Basic and diluted net earnings per share were also up to $1.83 per share for the full year 2024, compared to $0.40 per share for the full year 2023. It's good that the company has established disaster recovery and business continuity policies and procedures in place, which are very important with the uncertainty of severe weather, natural disasters, epidemics and pandemics, acts of war or terrorism, and other external events that could have a significant effect in our business. Prepayment speeds were 7.3% versus 6% the year before, with discount rates going from 10.5% to 10%. The unpaid principal balance was also down from $217 to $206. The report was signed by David A. Hedges, the president and CEO, on March 11, 2025. Now, let's zoom out and look at the bigger picture. Auburn National Bancorporation seems to be doing okay, especially compared to the previous year. Their profits are up and they are complying with regulation. I'd also say that these results appear to be aided by rising interest rates and economic conditions, as well as from their long-term growth plan. They also lay out the risks they're facing ahead, but their plans to prepare for and respond to disruptive events seem well thought out, so they don't seem in trouble for it. All in all, it doesn't seem like there's anything particularly alarming going on. Of course, there are always risks that the management recognizes and is planning around, and I suggest you consider for yourself the specific risks and opportunities it faces with a due diligence before making a financial decision. Thanks for watching, everyone. If you found this deep dive helpful, be sure to hit that like button, drop a comment with your thoughts, and subscribe for more corporate decoder videos.